welcome back to another episode of the Pi Podcast. I am your host, Irene. Thank you so much for joining us today. As usual, share, like, subscribe, invite a friend and a friend of a friend, leave your comments, share your experiences, and let us know how you're enjoying the content that we're putting out. Today's episode is a follow up episode from the investment series where we spoke about how your investments are protected by the various regulatory bodies. And so we're now tackling this from the pension perspective. Let's get started. Now, let's move on to pensions. So, with pensions, we're going to split it into three. We're going to talk about the defined benefit on its own. We're then going to talk about defined benefit and defined contribution. And then we're going to talk about the self invested pension plans. So we didn't cover the self-invested pension plans previously when we talked about pensions because that's a top-up outside of your occupational pension scheme, and it's usually utilized by individuals who want to top up their pension or self-employed people who want to have a pension. So I'll talk about that separately in another episode. But for today, you can have a look at the defined benefit, defined contribution episode that we recorded. That will help give you more context in terms of what we're discussing in this section. So quickly jump on to watch that and then hop back to continue with today's episode. So with both the defined benefit and defined contribution pension scheme, now as we speak about them together, the element of custody, as we talked about with investments, still applied. If you've not seen the video on investments, that's it over there. You might want to have a look at that to understand the element of the custodian relationship with the firm, and that will help you put this into context. I'm going to have to continue my conversation from this angle today because the sun is so bright and it's just glaring in my eyes. But I hope it doesn't disrupt your enjoyment of the content too much. So let's get on with it. So we'll pick up on the pension side of it now. So that's defined benefit on its own, defined benefit and defined contribution together, and the self-invested pension plan. In the UK, there is a body called the Pension Protection Fund, which was set up to essentially support defined benefit schemes in the event of insolvency. So if a company is participating in a DB scheme and they become insolvent and they're not able to continue to manage their pensions as they should, then the Pension Protection Fund will step in to ensure that the members are not affected too much by this sort of disruption. So in that case, if you are a member who was already in receipt of benefits at the time at which the company goes into liquidation, if you're a beneficiary as well of pensions from that fund, because perhaps your spouse or parent or somebody who nominated you as a beneficiary has passed on, then the PPF will ensure you continue to receive 100% of the benefits. There's other circumstances as well, such as ill health, where they ensure that you still receive those benefits. So again, look at the PPF website, which I will tag down below, and that will help you fully understand where you stand should you be in that situation. Now, if you're not in receipt of benefits and the company has gone bust and the PPF ends up taking over the management of the scheme, you are compensated at least up to 90%. They will try and make sure that you get at least 90% of your pension benefits. Now, I know it's not great because you do want to get 100%, but actually it's the lesser of two evils, if I will say so. If the company goes into liquidation and they're not able to support your pension scheme at all, the pension scheme could essentially really decline in value. And that would mean that you might get something, you might get nothing, you might get 40% of your pension benefits. And so the PPF steps in to ensure that a really great deal is negotiated in that process. And then you should be able to get at least 90% of your pension benefits under their management. So that covers the DB schemes. That's the sort of protections you have around that. You will be part of the Pension Protection Fund. You either get 100% of your benefits if you're already in receipt of them, or at least 90% of your benefits if you're not. Now, with the DB and the DC scheme, these ones fall back into the category of segregation of funds. So the reason why the DB scheme sits across the two is because in the event of liquidation, we're assuming that not all the assets have disappeared. Okay. And so, because the assets were segregated anyway, the employer has a responsibility towards making contributions into the pension scheme. So, for a defined benefit pension scheme, the scheme has to be fully funded for them to be able to sustain the payment of the benefits they have promised the employees or the pensioners. So, because we said they're defining the benefit that you're receiving, they'll say that you're going to receive X amount when you retire. They have to maintain that promise. And to be able to do that, there are projections made every couple of years to ensure that the scheme is in a position where it is fully funded. And should it not be fully funded, there are then steps, action plans put into place to ensure that the employer can continue to fund and perhaps even overpay, over contribute to ensure that the pension scheme remains fully funded or approaches fully funded over time. Now, the pension scheme can also be overfunded, which means it's over 100% funded. And in that case, the employer may pull back on their contributions towards the scheme. And so when it gets back to 100% or below 100%, then they can revisit their contributions. So, because of this need to be fully funded and because of the employer's contributions required to ensure that it is fully funded, that's where the PPF will come in to ensure that those contributions are maximized and that there is a way for them to be compensated. So that happens. For the defined contribution pension scheme, because the employer has already contributed, they essentially define the contribution they're going to make into your pension scheme. And because of that definition, it's already defined as a defined contribution. They don't need to ensure anything about fully funded schemes. They just need to ensure that they're contributing the defined contribution that they promised and that you're contributing what you are willing to contribute. And depending on how the assets perform, then you will get your pension at the end of the day. So the element that the PPF is truly protecting is the angle of being fully funded and the employer contributions, because your assets anyway would have been held at a custody level, like we've talked about previously. And at the custody level, there's a segregation which ensures that should the organization go bust, your assets are still protected. And in the event of fraudulent activity and so on and so forth, which we've already discussed, then there is compensation to be given to you. Now, for the DB scheme, that compensation is going to be £85,000, and for the DC scheme, up to £85,000 as well. For the DC scheme, you can go ahead through the FSCS to claim your compensation. For the DB scheme, the trustee of the pension fund has to go and make that claim on your behalf. So you have to get in touch with whoever is managing your pension pot and let them know that you would like to make a claim because of X, Y, and Z, and you can get that compensation up to £85,000. With the self-invested pension plan, this is essentially for individuals who are looking to invest outside of their workplace pension or individuals who are self-employed. You find a firm that participates in the self-invested pension plan schemes and you invest your pension through them. And so if anything was to happen there and there is some sort of insolvency or loss to your pension investments not related to performance, then you can be compensated up to 100% of your investment, with £85,000 being the upper limit. So when it comes to pensions, there's one scenario where you can actually claim 100% of your pension benefits. And this is if you're participating in a contract of long-term insurance. With a contract of long-term insurance, this would essentially be a model such as perhaps an annuity. With an annuity, you get specified cash flows over a duration of time. So, say for example that you're in a defined contribution pension scheme and you're about to reach retirement age and you want specified cash flows because we said what you're getting back is dependent on how the market performs. If the market is performing well, this year you might get, say, £60,000, next year you might get £30,000, and so on and so forth. So to eliminate that volatility of your income, what you can do is you can get into an annuity. And what the annuity does is you exchange your assets with an insurance company for specified cash flows. And you say to them, I'm going to give you my assets, and by doing so, you're going to promise me that I will receive £60,000 a year for X duration, or for however long in time, till infinity. Now, if you are in such a contract of long-term insurance and anything was to happen to that insurance company and it went bust and your assets absolutely disappeared or something went terribly wrong, you can then go to the FSCS and get 100% compensation with no upper limit. So annuities tend to be used by even individuals in defined benefit pension schemes where the employer is going to do that trade-off on your behalf, because again, the requirement for the employer to take on that risk might mean that they need to insure some of it. And so if you end up being an employee who's part of a scheme that has a contract of long-term insurance, then your employer is potentially in a position where they can actually help you claim 100% of your pension through the FSCS. So I know it's been a mouthful. I'm going to put a link as well to share with you guys, because there are several incidences where companies fail, investment firms fail. And I was looking at the register the other day, and the list of companies it's a lot. We don't potentially hear about all of them, but it's across pensions, investments, insurance companies, and so on and so forth. So I'm going to put a link down below for you to have a look at. Get yourself knowledgeable on the fact that there are protections available for you should these businesses end up in a difficult position. So I hope you've enjoyed today's episode, and I hope it's been really informative to you. I hope it's been clear and you gained a thing or two, and you do have the resources now to be able to go in and have a look at your investments or your pensions and check that they're actually safe, and that the advisors from regulated firms, the businesses and the firms are also participating in a regulated environment where the products and services they're also offering you are regulated to ensure that you get full compensation. Thank you so much for watching, and I'll see you next time. Bye for now.